Hello, my name is Martin A. Smith. I am the president at WealthCare Financial Group. WealthCare is a wealth management, retirement planning, and investment advisory firm. Our advisors are located in Georgia, Maryland, and also Washington, D.C. We are a state registered investment advisor. So I'm very happy that you decided to join us in this presentation. You've seen our advertisement entitled Pathways to Your Retirement, and we want to deliver just that, pathways, not just one path, but multiple paths that you can consider to achieve your retirement goals. This presentation is entitled Retirement, a Comprehensive Outlook. We have other presentations that are more modular, where it's just about one topic, whether it's estate planning or portfolio management or long-term care or women and money. This presentation is more comprehensive. It includes more than just one topic. So let's get started. Again, my name is Martin Smith, and I am a registered investment advisor. I've been in the business since 1999. I started with A.G. Edwards and Sons, and then went to Merrill Lynch. And then later I've left Merrill Lynch and launched an independent wealth management and investment advisory firm. And today we are WealthCare Financial Group. I am a chartered retirement planning counselor, as well as an accredited investment fiduciary analyst. So those are just certifications that I picked up over the years. I attended and graduated from Howard University with a bachelor's in legal communications in 1992, and also Georgetown University, where I received my master's in commercial real estate finance. And lastly, I attended an advanced retirement certification program at the University of Pennsylvania at the Wharton School of Business. So why are you here? You're here to gain a candid, unbiased view of a modern retirement. And I want to underscore that word modern, because retirement today and retirement 5 and 10 years from now is not like retirement 20 years ago. Because we have a completely different economy today than what we had even 5 years and 10 years ago. Our tax laws have changed dramatically. So we cannot think about retirement in yesterday's mindset. We've got to consider what impacts retirement today and what impacts the economy and the markets today. What we're going to be covering is wealth management. Exactly what is it? Because that's a term I'm sure you're familiar with. You've heard a lot. Everyone uses that term today, wealth management. Healthcare, long-term care, and life insurance. We're going to discuss estate planning and retirement income planning. We're going to talk about annuities because they're very controversial, so we really want you to understand annuities, how they work. And then we're going to discuss portfolio management, one of my favorite subjects. So, Section 1, Wealth Management Explained. What is wealth management? Wealth management is I think it's a new fancy word in our industry, like financial planning was the word years ago, and still is, but wealth management has a little more pizzazz to it, When you think about the aspects of wealth management, what does it entail? Well, a wealth manager is someone like myself who's licensed as a financial advisor, stockbroker, and what we do is we coordinate the activities of other professionals as it impacts you, our client, whether you're a business owner, whether you're an employee at a corporation, or whether you are just preparing for retirement or already retired. So it encompasses asset allocation, which is your portfolio. We look at your overall net worth through our financial planning process. We discuss tax planning and education planning. We deal with retirement planning, which is the subject of this particular seminar. We go into estate planning. We talk about survivor protection and income protection. Now, in order to accomplish all of this, you really need really a team of professionals. You need your financial advisor or wealth manager, your CPA or tax advisor. You also need your attorney. And then if your financial advisor, like myself, doesn't own his or her own insurance company, and if they're not an insurance agent, and I happen to own an insurance company and also have an insurance license, then you need a professional insurance advisor to talk about risk management. Here's a quote from John Bogle, the former CEO, he passed away, of Vanguard. Vanguard funds. He said, "If I have learned anything in my 52 years in this marvelous field, it is that for a given individual or institution, the emotions of investing have destroyed far more potential investment returns than the economics of investing have ever dreamed of destroying." That's really true, because what he's saying is that while the economy drives the market, and while the market does fluctuate and has been volatile, what really drives the market is not just economic cycles, but also people's emotion, the emotion of fear and the desire or greed. Fear and greed are two very powerful forces that impact the stock market. The economy drives the market long term. It sets a course, if you will, for where we can expect the market to be in the future. But fear and greed is really what has an impact on the market today in terms of whether it's very volatile or not. If you hear about a bomb dropping somewhere, or terrorists, or a pandemic, if it's bad enough, the market will react to that. If the president tweets something, the market's going to react to that. So the market is very skittish, and I try to help people really understand the importance of separating their emotions from the logic when it comes to their investments. You want to invest based on research and logic and empirical data and analysis, not based on your emotions. When you use emotions for driving your investment decisions, you're probably setting yourself up for losing some money. That's never fun. So, introduction. Today's retirement, or retirement today. Fresh challenges have changed the landscape, including interest rate changes. Yes, interest rates have been very low for quite some time, but interest rates are not going to stay low forever. Now, this is a great time for those who are considering buying a home, investing in real estate, because rates are low, so take advantage of it. But don't expect that rates are always going to be low. As real estate prices have appreciated, when rates go up, that same home may cost a lot more to purchase. If you're renting, you can expect rents to go up as well. So interest rate challenges have had a really big impact on the retirement landscape. Also, record-breaking market conditions and volatility. For example, we've had tariffs and a threat of tariffs in the last 12 months, and we've seen the market respond quickly and sharply to the announcement of tariffs, both by the president and also by China. The national debt. We hear a lot about the national debt, but I don't think we hear enough about the national debt. The national debt has grown about $1 trillion per year across a number of different presidential administrations, not just Trump, not just President Obama, but also Bush and Clinton. So the debt has been growing by about $1 trillion per year, and our nation hasn't done much of anything to resolve this problem. It could become a very big problem in the future. And so right now it hasn't really impacted retirees, but in the future it can have a huge impact on our economy, and also the stock market and overall taxes and so forth. So I want to keep that in mind. Geopolitical shifts. We've seen, for example, the Brexit movement in the UK. You've seen dictators be overthrown. We've had the longest war so far, which has been Iraq and Afghanistan. So there's been changes in leadership in countries. There's been shifts. We have a problem right now in Argentina. There's been geopolitical shifts that has occurred around the world, and that also impacts our market and economy. Tax changes. This is a big one. President Trump has issued a huge tax plan or tax cut, and it has done a lot for the wealthy and for business owners. Probably not as much for the poor, although taxes have been reduced across the board and the marginal tax rate has come down somewhat. So people are able to take home a little bit more money, but it's a little bit more money because we also have to keep in mind inflation has gone up. So if you're saving an extra $100 a month because of the tax breaks, but if you're spending an extra $100 a month because of the cost of goods and services, then you're still kind of where you were. So, but then again, if you own a business, there are a lot of benefits and tax deduction opportunities that you can take advantage of. Lastly, the 2008 market crash. That's had a huge impact on retirees. God forbid you retired December 2007, and because 2 or 3 months later you saw your portfolio take a a sharp dip. And we want to keep in mind that, yes, there was the combination of malfeasance as well as just the moral hazard of consumers who were buying more than what they should have in real estate. Those two forces combined created the perfect storm for what we now know as the Great Recession. Let's talk about health care, long-term care, and life insurance. So long-term care is really important because, thankfully, because of medical science, people are living longer. Medical science have improved the longevity of life and the quality of life for many. The challenge is we still have to finance that longevity of life. So 70% of retirees will need long-term care at some point in their life. In 2016, the average cost for a semi-private room at a nursing home was $82,128 per year. Think about this. A person who has retired, paid off their home, enjoy the comfort of their own home, which they've lived in for decades, and now, unfortunately, they've got to go into a nursing home facility of some sort. They're going to be in a room, not a big house, a room. They're going to pay $82,000 for that room and have a roommate, a stranger. So that is a huge adjustment to someone who's previously enjoyed the comfort of their own home. So long-term care is devastating if a person needs the medical treatment, the medical care, but don't have the money to pay for it. It's very costly. So you want to understand what it is, how it works, and how to qualify for, which we're going to discuss in this next slide here. So the average health care bill for a retired couple in 2018, looking about 11, 13 months ago roughly, was $280,000, the average health care bill. As a result of physical and cognitive impairments, 70% of seniors will need long-term care and support. That's 7 in 10 Americans aged 65 years or older. So 3/4 of retirees are going to need long-term care, and they're going to need it for about 3 years. So think about that. You're talking about $300,000+ for 3/4 of our elder senior population here in this country. How do you qualify for long-term care? Well, there's a process. There's what's called activities of daily living. There's 6 things that you would have to not be able to do, 2 of which, if you can't do 2 of these 6 things, then you can qualify for your long-term care benefits. You would have to need assistance with either bathing, personal hygiene and grooming, dressing, eating, toileting, and transferring/walking. If you cannot perform 2 of those 6 identified activities of daily living, then you could turn on your long-term care benefits. Now, let's talk about life insurance, because some years ago, about 10 years ago, you could find insurance carriers that sold both long-term care separately from life insurance. A lot of those carriers today no longer exist. So now we have this hybrid type policy that combines long-term care and life. But to understand it, I think it's important to understand how life insurance works. So there's really like 4 or 5 different types of life insurance policies. There's term life, which is suitable for someone who's a younger couple. They need more coverage, maybe have young children, but cannot afford large premiums. And it's term. It runs out in 10, 20, or 30 years. You decide the term. And then there's whole life, which is permanent life insurance you pay through your entire life, and you have a set face amount of the insurance policy. The cash is in a separate account that grows tax deferred, and typically you get about a 2% yield to 3% yield on that cash value portion. Just depends where interest rates are. There's also universal life. Universal life is like whole life, but the difference is it's more flexible. So suppose you had $100,000 of whole life, and now you want to increase the face amount to $500,000. Well, if you have a whole life policy, you've got to purchase a separate policy for $400,000. Now you have 2, put the 2 together, and that makes $500,000. With universal, you simply go through some health underwriting, and your policy can be adjusted from 100,000 to 500,000 without having to buy a separate policy. Yes, you're going to pay a little more in premiums, but you're not going to own two different policies. It's more flexible. Index universal life is unique because the cash value in this type of policy is not only is it tax deferred, but it's pegged to a stock market index, the S&P, the Dow, the NASDAQ, or some investment firms will build a indice that is based on, small cap or mid cap or something. It'll be comprised of mutual funds, but really like an index. And so you can get greater than the base 2 or 3% annual yield. Your returns can be a lot higher. Unlike universal life or whole life. Another feature of Index Universal is that it can be used as a key person policy for business owners and employees. And also the cash value, that portion is insured against loss. So if the index is negative, you're not going to be negative in your cash value. You just won't get any returns. You get the base return that the policy offers, which is usually between 2 and 3%, but you're not going to take a loss like you would if it were a mutual fund or a stock or an investment in your 401k or IRA. So in this regard, there's a floor, and that floor kind of shields you from market losses in a negative year. Now, let's take a look at the hypothetical long-term care hybrid mixed with a whole life type policy. A life insurance with long-term care rider is really what they're doing. So the underwriting is still based on your mortality. The premiums are set; they won't increase. The benefits paid, you have to pay. The benefits will be paid if you meet the requirements of not being able to perform 2 of the daily activities of daily living, and benefits are paid out as an accelerated benefit or as a death benefit. So here's what that means. Imagine if you have $1 million face amount of the insurance policy. In this case, it's a hybrid life with a long-term care rider. If you need the long-term care portion to kick in for yourself, what you could do is liquidate part of that face amount. So they'll take $1 million and over a monthly basis pay you between 1 and 4% of that $1 million until the $1 million runs out. So you're talking about $10,000 to $40,000 per month from that $1 million of insurance to cover long-term care expenses. If you pass away before the money is completely exhausted, the difference goes to your beneficiary. If you use it all up, then you use it all up. So that is the hybrid version of life with long-term care. By the way, the cash value could still be borrowed without paying taxes because it grows tax deferred. You can borrow it, withdraw it really, tax-free. So if there's some cash value, suppose you built up $200,000 of cash value, you got $1 million face amount. In some of these policies, you can pull out, let's say, $50,000 to $100,000 of the cash value without negatively impacting the face amount and still draw down on the face amount of the policy to cover your long-term care expenses. So it's very tax efficient in that regard. Let's delve into estate planning. So when you think about estate planning, we're talking about everything that you own. Your home, your cars, jewelry, clothes, land, whatever it is, your IRA, your 401k portfolio, whatever those assets are. You've got to decide, who do I want to receive those assets and when? Who should manage those assets? Who should care for my children or dependents? Who should make health care, welfare, and financial decisions on my behalf? And what do I want my funeral arrangements and final resting arrangements to be? And how do I want to cover those costs? These are all of the important considerations that you have to make as someone who is planning your estate. If you don't make these decisions before you pass, someone will make them for you, I promise you. And usually it's going to be the government. So some estate planning terms that we want you to be familiar with. A will. A will is a legal document that declares and controls how a person's property and assets are distributed after death. So we're talking about you expressing your desire to bequeath your estate to your loved ones or intended beneficiaries, making them inherities of your estate. Okay, so that could be your home, your car, your clothes, whatever. Probate, that is the legal process that requires a will that is a legal process that requires a will to determine if it is valid and authentic, and to ensure that the will is followed by appointing the executor named in the will. So we're going to make sure through the court process that your will is valid and that it is authentic, and that your wishes are followed by appointing an executor who you have named in the will before you died. Power of attorney. It's a legal document that gives one person the power to act for another person. That could be a family member, an attorney. You can make that decision. A living trust is important because with a living trust, you can potentially bypass really your loved ones, those who inherit your estate. They can bypass the probate process by simply providing a copy of a death certificate. Your will and your living trust will go together. So you will express in your will who receives what, and your trust is actually a separate entity that will hold those assets. So you would title your house, your car, your other assets into the trust, and then in your will you will declare who's to receive those assets. You're going to be the trustor, and the person who you trust to administer this for you is the trustee. And then you're going to name beneficiaries, typically loved ones, family, beneficiaries to the trust to receive those assets. And so this way you can save a lot of time and a lot of money and a lot of court costs by having a living trust prepared, and still receive the professional services of an advisor or an attorney to help you. But you're going to, in a sense, bypass that probate process, which is a lot of savings and a lot of peace of mind for those who have to manage and deal with your estate after you're gone. Let's discuss retirement income planning. So income needs and income risks. Common income sources are defined benefit plans, or what we call pension plans. Corporations used to offer pension plans back in the day, so to speak. Today, pension plans are almost a thing of the past. A lot of companies don't want to offer a pension plan. It's debt on their balance sheet. They don't want to cover that cost for your life expectancy. So they put the onus on you and I by saying, set up for yourself a defined contribution plan. They'll set up a 401k. They'll be the plan sponsor of your 401k. And then you have to contribute to your retirement yourself. And they will match a certain portion. Then there's the individual retirement account, or the Roth IRA. Social Security is an income source. Annuities is definitely an income source. Dividends and interest from stocks, mutual funds, bonds that can pay a dividend and/or an interest. And lastly, rental property / real estate. That is an asset class that I think a lot of advisors don't discuss, and I can understand why. It's complex. However, I have a master's in commercial real estate finance, and I understand real estate. I used to be a commercial broker years ago. So I'm able to offer advice about the acquisition and disposition of real estate assets, and help you understand the importance of real estate within your overall net worth and your overall portfolio. Some common risks to income is longevity risk, the risk of outliving your income. And then there's inflation risk. Assets will not be able to keep up with inflation. I saw actually today a Facebook post that I posted 3 years ago, and it showed gas prices. I took a picture of gas prices at Wawa gas station in Bowie, Maryland. The price of the gas was $1.99. That was 3 years ago. Gas is a lot more today. And so that's just one example of inflation. Will your portfolio keep up with inflation? Market risk is a risk that an investor will experience loss due to factors that affect the performance of the financial markets. Then there's tax risk that taxes will rise significantly. We know that's driven by who's in the White House and who controls the Congress and/or Senate. There is also health care and long-term care risk. That is, well, actually, the cost risk of that is those costs are exorbitant, they're going up, and it could really ruin many, many years of saving in a 401k or IRA when you have to shell out two-thirds of that money to cover long-term care costs. There's relationship risk, and unfortunately, we see a lot of this is when people get divorced, if there's a marital status change, there's a risk to the value of that person's net worth because it's cut in half. So divorce risk, loss of a spouse, loss of dependents, loss of caregiver, and/or unforeseen family needs. So these are just some of the risks that you want to be mindful of that can have an impact on the overall value of your retirement assets. Okay, let's discuss annuities because there is a lot of controversy about annuities. I've heard that they're horrible, that they shouldn't exist. I've heard that they're great, and we've seen people on television, so-called professionals in our industry, that will say annuities are horrible, and others will say, oh, they're great. You've got to understand why they're saying that. I'm not going to name any names, but I know one particular female who comes on television, used to be on television a lot, and would have horrible things to say about annuities. She never mentioned the fact that she used to sell them herself. So, I think the issue here is suitability. There is really no inherently good or bad product or service in our industry. It's all about suitability. What is suitable for you? So let's discuss the 4 types of annuities and the features. There's an immediate annuity, meaning that you basically, let me illustrate here with a little pen to make this somewhat interesting. So let's do a little bit of drawing here. Here's a $, okay, and here's $100,000. So let's just use this 100K. I know it looks like I'm a kindergartner, but I'm using a mouse, so forgive me. So here we go, $100,000 invested in an immediate annuity, okay? Now, your rate of return determines your monthly payout. So immediate means that when you put the money in, it starts to pay a rate of return, a yield, a payout immediately. Principal protection, not really worried about because you're drawing down on this money, okay? Tax-deferred growth. The interest distributed is taxable. Lifetime income rider available, yes. People do this because they want income for life. Lump sum available? No. You're going to get a yield greater than what you can get at a bank, so when you put this money in an annuity, in an immediate annuity, you're annuitizing it. It becomes really the asset of the insurance carrier, and you receive the interest payments for life. Who is this for? Who could benefit? Someone seeking immediate monthly income. Now, fixed annuities. Just that, it's fixed. Guaranteed interest rate. Yes, there's principal protection. Yes, there's tax-deferred growth. Yes, there's a lifetime income rider available. And yes, the lump sum is available. You can take it out after a number of years. Someone seeking a fixed rate, oftentimes higher than offered by a CD. So again, that's who benefits from a fixed annuity. If you want a yield greater than a CD, you don't want to give all your money to the insurance company and be dictated a rate of return or a yield or payout. You want the potential for a payout if you so choose, but eventually you're going to want to take a lump sum and receive all your money back. Fixed index annuity. Now, there is upside potential, meaning that because the underlying investment that's driving the income, the fixed account is an index or an index backed by mutual funds. So you have the potential for rate of returns that are like stock market like returns or S&P 500 like returns. There is no downside loss potential because there's a floor under it so that if the market performs upward of 10%, you get a 10% return. If the market is negative, let's say it's negative 8%, you don't lose anything. The annuity typically pays a base yield of between 1 and 2%, so you could still get the upside without the negatives from the downside. And then the answers are all yes. There's principal protection, tax-deferred growth, lifetime income rider available, and there's the lump sum available. I want to specify here and just really mention this lifetime income rider section. This is really key. With this type of rider and these annuities, it allows you to illustrate, and we do this all the time, where we'll show $100,000 invested, for example. You're pulling out, let's say, I don't know, $5,000 or $10,000 a year over a 20-year period, and over the 20-year period, you've actually pulled out greater than your initial $100,000, and at year 21, the illustrations typically show that you have still more than $100,000 in the account. So we're talking about the power of the index impacting the fixed account to give you a rate of return that is sufficient for your income needs and also have the principal there at the end of the term in the annuity. Those are just some features. Variable annuities, a little bit different because that cash account is really backed by mutual funds. The sub-accounts is what they're called. There's no principal protection. So while there's income protection, while your income that you receive on the annuity is protected, the principal can fluctuate. So for example, this is the plus sign, this is the negative sign, and here's your $100,000. The $100,000 will grow or fall and fluctuate with the market. Your income will never dip because there's a guaranteed income stream that you receive even if the $100,000 market value is less. If the market value grows, they lock in those gains, which means that your income increases. Okay? So you have the potential in the up years for your income to increase without the negative possibility of your income falling if the market drops. Although the face amount, the market value, can fluctuate up and down. So that's a variable annuity. I don't really like these so much, and also they have, some higher fees. Fixed annuities became more popular about maybe 10 years ago. Variable annuities used to be very popular, and I think before the recession of 2008, they were even more popular. But I think fixed index annuities for retirees today is probably more suitable because you can get the same features, the same benefit without the risk, and also the fees are less. So I'm glad that the insurance industry came out with these because it has really served to replace this. Excuse my little squiggly little looking arrow, but I think you could replace this with this and save yourself a lot of money, and also reduce the risk exposure in your annuity. So that's just a little bit about annuities. Again, they're not for everyone. Suitability is so important when you're talking about whether or not any product is good for someone. I think if an advisor comes to you and says, hey, I want to do financial planning for you, let's take a look at your finances, and they're going through all this stuff, and then if they walk into a meeting with an annuity in their hip pocket, that's not being objective. Your needs must determine what that advisor recommends, not what he or she wants to sell. So be very careful. Annuities aren't horrible. They're not great. It all depends on what you need. If it's suitable for you, then I highly recommend it. If it's not suitable for you, stay far away from it. That's the truth on annuities. Let's look at and illustrate once again how the income impacts your retirement, whether you're in an annuity or not in an annuity. Okay? So if you're basically investing and have exposure in the stock market, this is actual returns, by the way, from 2000 through 2018 of the S&P. So we can see here the red, that's losses, and then here's the gains in the portfolio, and one more loss, and one more loss. So we've had 5 negative years and a lot of positive years, 13 positive years in this illustration from 2000 to 2018 in the S&P. Initially, $250,000 was invested. Ending market value is $9,768. $237,500 was received because of the annual withdrawals of $12,500. Now, in an annuity, like an equity index annuity, these negative years, they don't hurt you because you're not going to be impacted from when the market is negative. You're only going to get the gains. So the negative years, by comparison, here is a big negative, almost 37%. And look at this, 0. So if you receive 13% in 2006, and then 3.5% in 2007, you gave back 36.99% in 2008, and you haven't broken yet even. You haven't broken even yet in 2009, although you have a 26% gain. Here, there's no losses, just gains. So at the end of the 18-year period, here you have $9,768. You've received $237,500 in an unprotected account. In an annuity, equity index annuity, you've got $203,000 left, and you've received $237,500. So your overall value is well over $400,000. Quite a big difference, especially because you didn't take these losses in these years, just the gains. Okay? Now, let's ask sort of a silly question. Would you rather have a 5.58% average return or a 5.17% average return? Let's look at it. Again, using those same years from 2000 through 2018, negative 10, negative 13, negative 23, positive, negative almost 37, positive, negative 6.78. The average return was 5.58%. Okay, that's better than a CD, at least, right? Now, your $100,000, here's how it has here's how it's fluctuated. So you've lost, some value. Here's 89,000, 78,000, 59,000, 75,000, 82,000. You don't break even until right here. Talking 12 years in, you finally have $108,000 in 2012. And then it goes up from there to $210,000. So you had a lot of volatility, a lot of losses, a lot of years you had to wait to break even and get to a positive value. Looking at an annuity, an equity index annuity, where they provide a 50% participation rate on the positive gains, meaning if you get a 10% return in the S&P, they'll pay 50% to your annuity value, so now you've got a 5% return. Okay, so real quickly, participation rate, or what we call par rate. Par rates, they could exceed and often do 50, even 100%. I've seen par rates as high as 180%. So if the S&P is up 10%, you receive 18% return in that 1 year. So par rates have fluctuated, but I think still most of them I've seen today are still like at 100% or 125%, which really isn't bad. So we're talking about a 10% negative here, negative 13, negative 23. The par rate is 0, as it should be, but here in 2003, when the positive return is 26%, the par rate is 13.19%. So the par rate is exactly 50% of what the market did in this example. Again, they're using a very low par rate example because par rates are typically about 100%, some 125%. So they're underestimating, which I think is a good illustration to underestimate. Okay, so sort of like under promise, over deliver. So the average return is 5.58% if you just take these performance numbers from 2000 to 2018. The average return with a 50% par rate, or participation rate, is actually 5.17%. So one is big and one is smaller, right? So logically you would think, oh, I'll take the 5.58% return because it's bigger than 5.17. Let's take a look at it. Let's look at it in the actual terms of how this works inside of an equity index annuity. Market risk, how annuities work. So here's a 5.58% and the ending value. And here's a 5.17% and the ending value. Why is 5.17% greater than 5.58%? The reason is because you don't have these negative years sucking the wind out of your portfolio. You just have positive years and you have more positive years. So this negative doesn't hurt you. These don't hurt you. That doesn't hurt you. So at the very end, you come out with a greater market value. That is the benefit of comparing the performance of the S&P 500 in an account that has no protection to it versus an account that is insured that's inside of an equity index annuity if and only if that product is suitable for you. It's not suitable for everybody. So I want you to keep that in mind, because when you make a decision based on what you see on television versus actually having the numbers made plain and illustrated for you, you can be hurting yourself by not getting something that could help you. So just be careful, buyer beware, but sit down with a professional advisor and run through the numbers. Have them prepare an illustration for you based on what you currently own. If you own an annuity or bought an annuity 5-10 years ago, look, have it compared to what's available today in the marketplace. You might find that the benefits have increased greatly. You can get a lot more for the same dollars. So that's, I guess, my overall explanation of how annuities work. But, sit down with your advisor, run through the numbers, and determine what's best for you. Let's discuss portfolio management and asset allocation. So there's a difference in correlation versus diversification. Correlation is looking at one or more, or really two assets, at least two assets, and comparing how they perform in relation to one another. So when they're correlated, they move in the same direction. Okay? Diversification means that what's in your portfolio should not be reflected by a pattern that is similar to each other. It should move in different directions. That's the impact of diversification in a portfolio. Now, so correlation, we want to understand what it is and how does it relate to diversification. Is diversification becoming more difficult? And how to identify adjustments to diversify a portfolio. Diversification is a risk management technique that utilizes a wide variety of investments within a portfolio. The idea behind this technique is that by constructing a portfolio with different kinds of investments, it will typically yield higher returns, typically, with less risk than investing in a singular investment. In simpler terms, it means putting all of your eggs in various baskets versus one basket. So I've seen portfolios that are diversified. Unfortunately, they're diversified in name only. In other words, when I look at my competitors' portfolios often, when we do a complimentary portfolio review and comparative investment analysis for our clients or prospective clients, I'll see that they have multiple things in their portfolio, a bunch of mutual funds, a bunch of exchange-traded funds, a number of stocks. And when I run the analysis to see what those investments are actually invested in, and whether they represent large cap, mid cap, or small cap, real estate, bonds, or international, I tend to find that although people are diversified, meaning they own different things in their portfolio, it still has a positive correlation to the various investments in that portfolio. In other words, it's like, what's the use of having a portfolio that's diversified if everything moves in the same direction as the S&P, the Dow, the NASDAQ? You want it to move inversely to those indices. Okay, so let's talk about diversification. When you're diversified in asset class. So you have large cap, mid cap, and small cap investments. The cap represents capitalization. Basically, it's a formula, it's a calculation. You take the price per share of the underlying stock, multiply that by the total number of shares outstanding. That gives you the size, or i.e. the capitalization of that particular company. So when we say cap, we mean capitalization. So small cap is just that. Then you have value and you have growth. Okay, so let's put that, excuse me, but I'm writing with a mouse, so just bear with me. So when you think about it, your portfolio is going to chart somewhere in here by percentage. What I tend to find is that a lot of people are diversified, but they are primarily in the large cap value and growth asset classes with a lot less in small and mid. There's also real estate, okay, like REITs, real estate investment trusts. There's bonds, right? And there are international investments. And lastly, commodities. Your portfolio should be comprised of small value and growth, mid-cap value and growth, large cap value, real estate, bonds, international, and commodities. These are all what we refer to as asset classes. Then you have geography, meaning where these companies are located around the world. You've got the diversification of time, how long you hold on to an investment. You have the size. Again, size sort of represents the small, mid, and large. Then you have the instruments. So over here are the instruments. Real estate, bonds, international. Okay, that is how you achieve true diversification. So we talked about correlation in terms of investments and the degree to which two securities move in relation to each other. Let's take a look at what this looks like on this chart. This is a positively correlated, non-diverse portfolio. This is what I normally see when I look at portfolios from various brokerage firms. I see typically a number of mutual funds, a number of exchange-traded funds, but for some reason, they all sort of seem to fall in the large cap category. And I'm always asking, hey, why is a disproportionate percentage of your portfolio in large caps and a lot less in small or mid caps? Does your advisor know that since 1927, small cap value as an asset class has had better performance in 3, 5, and 10-year running periods? How do I know that? I'll show you that. You got to come in the office for this one, but this book here by Dimensional, it gives me the performance of every single indice that's out there. It charts that performance from 1927. So I could see what every indice, S&P, small cap, mid cap, large cap, I can see what it's done since 1927. So when I run a portfolio review, I'm looking at raw data. I don't care about what mutual fund company it is or who the portfolio manager is. I don't care about that. I look at raw data. The raw data I look at in that book, it tells me what the performance is of every indice. And small cap value as an indice, as an asset class, has had the best performing numbers in 3, 5, and 10-year rolling periods since 1927. So me knowing that, based on this data, I'm wondering, why isn't more of the portfolio leaning in small cap value? Why are people typically grossly diversified in large caps? I think either the advisor doesn't know or the advisor doesn't know. But you should know. And we've been able to reduce risk, broaden the diversification, and increase performance by simply understanding that simple truth and doing the math and redesigning portfolios to fit the asset classes that have a better longer-term track record. And we do that within the risk tolerance of the client, whether they're from conservative all the way to aggressive. So this is positive correlation, non-diversified, everything moves in the same direction. Here we have inverse correlation, diversified. And as it should, these investments are crisscrossing because the idea is that you're going to own different things in your portfolio, disproportionately weight them by the percentage of the investment that you own, and it's going to give you the diversification in performance and also in costs as well. Now, why do we diversify? We diversify because of this. Risk. It is inevitable. It happens. That is why we diversify. Not because the market goes up, but because the market does have these dips that are unpredictable sometimes. And that's where we demonstrate our value. That's where you have peace of mind, knowing that when this happens, you're going to be able to weather the storm. Okay? So it's all about managing risk. Market risk, the value of a security may drop, and they do. Inflationary risk, the security may not keep pace with inflation. Liquidity risk, you may not be able to sell the security easily. And then there's other types of risks. Now, with respect to liquidity risk, you want to be careful, because one step we take is when we invest for many clients and build a portfolio, we dollar cost average. We don't always just dump $1 million in the market and diversify. Why do that when the market can be up today and down tomorrow? Why not take that money, put it in an account that is going to get a higher yield on it, and then over a 6-month or 12-month period, move a small portion, 1/6 or 1/12 of that portfolio, into the diversified model, so that you're dollar cost averaging, you're averaging out the performance as well as the fluctuations. You may invest one day when the market's high, you may invest for a number of months when the market is low. Seems like it's reasonable, because if you're a long-term investor, you're going to sort of smooth out the volatility in your portfolio, and that can have a positive impact versus just taking the whole amount of your investment and dumping it in this portfolio to watch the market rise sharply or fall sharply the next month or the next day. So I think dollar cost averaging is still an important method for protecting yourself to some degree after you've done the work of diversification. Now, back to emotions. Rule number 1 is investing devoid of understanding is gambling. You might as well just go to the slot machine. We emphasize financial literacy in our practice. We emphasize learning. We study the market. We study the economy. We read books. We look at publications. We are thinking about what drives the market, understanding the economy, and then making well-informed decisions, and you should as well. If you're not doing that, you're going to be driven like the greed and fear example here of the person on the roller coaster. Okay, that's your experience. You have more fun gambling, because it's not fun sleeping at night when your portfolio is down 20-30% because you didn't do the required reading or hire someone who does. So why gamble with your retirement? What we have here is what we call the quilt. All this represents is basically asset classes expressed as the S&P right here, or the S&P 500, high yield bond index, Russell 2000 small cap index. And what you can see is that from 1998 to 2017, at least one of these various asset classes had the best performance for that given year. But no asset class stays on top forever. S&P 500 is here on top, and now it's here at the bottom, and again on top. Russell 2000 is on top, in the middle, here, in the middle, right? So if you think about it, you want to be diversified, because every asset class, maybe 1 year out of 10 years or so, will have its heyday year, so to speak, and will sort of lead the pack of your portfolio. You don't want to be non-diversified, not in a market that's as volatile as what we've seen. So the economy drives the market. This is really important. You got to understand this. The economy drives the market, and think of the economy as a big, as a Titanic. It doesn't make fast, sharp turns. It picks up steam as it goes, and it makes wide turns. You can see where it's turning, In a sense, it telegraphs itself. How does the economy telegraph itself? Every quarter, there are announcements. There's announcements about employment, about interest rates, about manufacturing, about the gross domestic product. There are these announcements that come out every quarter, and it gives us an indication of the overall health of our economy. And that's how we can keep a report card also on who's in the White House and what decisions they're making. And so we can test and measure the health of our economy quarter to quarter. That gives us an indication of what we might expect the stock market to do in response to the economy. I think of the stock market as a speedboat. I like speedboats. I've been on them. I've driven one across Lake Tahoe, actually to the middle of Lake Tahoe, really, really, really fast. And I was making some sharp turns just to see how the boat would handle. And the stock market can just make some quick moves up and down really fast. The economy, it's slower. And so the market is more so driven, like I said, by greed and fear. The economy is driven more or less by policy decisions, okay? Those things and what happens in corporations, the qualitative decisions that impact the quantitative, the value of corporations, that impacts the economy long term, and that sort of sets a course for what we may expect in the stock market. So you've got to understand the economy if you're going to be managing portfolios, especially working with a professional advisor with respect to your 401k and IRA. Now, this chart is really sort of what we call standard deviation. This is reward, what you earn. This is risk, what you lose. So the best place to be, if each of these stars represents a different mutual fund, exchange traded fund, or stock or bond in your portfolio or cash, this is where it charts. So the best place to be for your overall portfolio, which is represented in this star here or this star here, would be right here. That's the best place to be and the safest in this chart. Why? Because the risk is so low, the reward is so great. The most aggressive place to be is way out here. Okay? The risk is high. And, well, actually it's high. Looking at the 32% potential on the downside. Right? So high risk potential here. High risk here, high reward here. The overall portfolio, when you take, for example, 50% large cap, 50% bonds, in this example, it charts right about here. If you take 33% large cap, 33% small cap, and 33% international, that charts right here. So by adding small cap as an asset class and international as an asset class to this example, we've shifted from this position to this position. We basically have moved from here on our risk to right about here, made the portfolio a little less risky, if you will, and increased the value potentially from this position to that position. Okay, so when I look at a portfolio, we do plot it on a scatter chart like this to kind of get a sense of what the standard deviation of that portfolio is. And I want to see where your portfolio plots on this chart. If you're going to be over here or if you're going to be over here. Okay, and our objective is to get you in this direction and get you closer to that position. That's the value of what we do. That's what portfolio management means. Let's try to reduce the risk, increase the returns. We do that by building model portfolios from conservative through aggressive. Now, it's easy to go from here to here. It's difficult to start here and to get yourself back over here. Why is that difficult? Because if the market drops after you invest, you got to wait till the market comes back before you can get your money back from here to here. So I always tell people dollar cost average into these models. Why? Because if we dollar cost average, we can have, let's say, I don't know, some large amount of money, and over a 12-month period or over a 6-month period, we're going to move once a month a little bit into this model. Even if we start right here in the moderate position, or even if we start here in the moderate growth position, by month 3 out of 12 months, you still have 9 months left to slowly fill out the model. You're not just going to dump everything in here, which is the same thing as starting from conservative going straight to aggressive, because once you're fully invested, you're fully invested. I think sometimes it does make sense to be fully invested from day one, but in a volatile, unpredictable market, when, especially like in an election year, I think it makes more sense to sort of be more conservative and slowly sort of move yourself, your money into the market in a diversified fashion, whether you're conservative, moderate growth, or what we call aggressive or growth oriented. So that basically wraps up our webinar here, Retirement, a Comprehensive Outlook. You've been exposed to a lot of our thinking about retirement and what impacts retirement and sort of our approach to it. What we do in our practice is we offer everyone a complimentary written financial plan. It includes an estate planning module. You're able to link 401k, IRA, brokerage accounts, checking and savings accounts to it, and you can actually see your various accounts in real time as an account aggregation service is really what it is. It does your budgeting. You can project retirement income from the future. You can you can download your portfolio data, and we can look at how aggressive or conservative you are or need to be. And it's a complimentary service. It'll save you about $2,000. So I highly recommend it. And it's one of the 6 choices that we offered on that first landing page that you saw about choose your pathway to retirement. I'm very grateful and glad that you decided to view this webinar. My name is Martin A. Smith. I represent WealthCare Financial Group. If you have any questions, you can contact me. Here's our contact information. Give us a call. Send us an email. Stop by our office. We look forward to hearing from you. You have a wonderful day. Thank you so much, and be blessed. Take care.